webinar, and we'll be looking into 4 steps in forex trading. First steps in forex trading. So you want to look into how the forex market works. It's very interesting for you to know. For majority of you who are joining this webinar, I want to believe you are new to the market, and then you want to understand what are the steps required for you to start your career or your journey in forex trading. So today we'll be looking at first steps in forex trading. So I would like to know the various locations each of us are communicating from. I can see some persons already on the comment section. I can see Oseni Olaiton. I can see Cartel. So just tell me which country and then which state are you watching from. Awesome. So while I allow you to drop that in the comment section, I will proceed to the webinar. Now, the question is, what is forex? That's the first question we need to understand. What forex truly is. Now, from the word forex is an abbreviated word. It's 2 words that are brought together, which is foreign exchange. Foreign exchange, right? These 2 words are brought together. Foreign, then exchange. So the first 3 letters alphabet was taken, and the first 2 alphabets was taken. That's how we add what we now have. What? Forex. Can you get that? Awesome. So now forex has to do with the buying and selling of one currency in exchange for another. Now imagine you want to travel out of the country. Let's take Nigeria as a case study. You want to travel out of Nigeria to the United States. Now you would need to convert your naira, which is being spent in Nigeria. You need to convert it to USD, dollars, which is being spent in the United States. Now this conversion is called foreign exchange, right? So you are converting one currency for another currency. The moment you are buying one currency, which means you are getting another currency in return. That is foreign exchange, right? Okay. Now in the foreign exchange, currency pairs are what is being traded. Now currency pairs are made up of 2 different currency. Just like we say, when you say a pair of shoe, you know that okay, this shoe, there are two shoe, right? So they say a pair of shoe. Now a pair of currency, the currency pair is 2 currencies that are quoted together. Now say a currency pair is the quotation of 2 different currencies with the value of one currency being quoted against the other. So as you can see here, we have euro being quoted against the USD, the pounds being quoted against the USD, the dollars being quoted against the yen, then the dollars being quoted against Swiss franc, then the dollars being quoted against the Canadian dollar, then the Australian dollar being quoted against the United States dollars, then the New Zealand dollar being quoted against the US dollar. Now you can see, so currencies are traded in pairs: a quote currency and a base currency, right? Fantastic. Now let's take a more deeper dive to look into what this currency pair is. Now I said earlier on that the currency pair are what? A base currency and a quote currency. Now look at this. Look at what we have here. We have Euro USD, right? Now this euro is the base currency. and this USD is the quote currency. Now, the base currency, which is euro, is the basis for the transaction. I would explain in our next slide. Now, you see that the base currency is the currency you are buying when you trade Forex. The currency you are buying when you trade Forex. Now, you look at this. Right? This is the base currency. The USD is the base currency. The Japanese yen is the quote currency. Right? Now, the base currency, which is the US dollar, is what you are buying in exchange for the pounds, which makes it the basis of the transaction. Now, the quote currency is the currency you are selling when trading. So when you are the quote currency is JPY, because if you when you are selling JPY, which means you are buying more USD. So the quote currency is the currency that you sell to in exchange for the base currency, and the base currency is the currency that you buy in exchange for the quote currency. Let's press on. Now, this is a more explicit graphical way to explain this. Now, this is the British pound, and this is the United States dollars. Now, the base currency is the currency you are buying when you trade the pair in Forex, and the quote currency is the currency you are selling when you trade the pair in Forex. Right? The next one. Now, the foreign exchange market. The foreign exchange market. Now, the foreign exchange market is a global market. It is called over-the-counter market for trading of currencies. This market determines the foreign exchange rate for every currency. Now, the Forex market is one of the largest type of financial market, right? Because it's so big, and an average of 5 trillion dollars is being traded every day, every single day, and a $5 million of volume is being traded in this market. So that makes the foreign exchange market very unique, because it's a market where exchange rates are determined, and because of exchange rate being determined in the financial in the forex market, it is an indispensable market. It is indispensable, right? Yeah. Welcome, Montana. Welcome, John Obioma. Welcome, Smart Mon. Welcome, Shedrack. Yes, you mustn't miss this. So you pay attention, right? Great. Now, the transactions that are done in an exchange of a specific country's currency for another at an agreed rate, that's Forex. Now, when you carry out a transaction, you buy FX at a particular rate and you sell at a particular rate. That is already Forex trading, because you are buying a currency at a cheaper and accessible way, and you are selling it at a higher value, where you can make profit from the margin, right? Okay. Now, the forex market versus the exchange office. Now, in the forex market, it is global and it is decentralized, because there is no central unit controlling the forex market. It's a global market. Now, number two, there are general prices and can't be manipulated. So the prices in the forex market is influenced by demand and supply. Number three, it enables immediate and instant exchange. So when you place a buy, it on the forex market, it instantly executes, right? It instantly executes. And four, it is very safe, as no physical bulk is required all the time. Now, a lot of persons would not have to, because of the advent of the forex market, a lot of persons would not have to be carrying so much larger volume of cash right? Larger volume of cash, then it is being traded in the market. Now, the exchange offices are mostly local. Then prices varies and can easily be manipulated. I'm talking about a physical office. So it's different from the foreign exchange market in this sense. I'm sure many of you have seen going to change the dollar at the parallel market and all that. That's quite different. This is a global market. Yeah. Okay, let's take a deep dive. And the fact that trades are conducted over a network of computers rather than one physical exchange that closes at a particular time. Now, one fantastic thing about the forex market is that you can trade from your phone. So it's not there is no need for so many networks of computer. No, from your phone you can carry out foreign exchange. Yes. Now, I'm sure many of you have come across these terms. We call it the quote, the bid price, and the ask price. The quote price, the bid price, and the ask price. So I'll give scenarios, but let me just give a rundown of what I have on my slide here. Now, a quote price is the price of one currency in terms of another. Now, how do I mean? When you have one currency, let's take the naira for example, and you have the naira to $1 is 410, right? I'm giving an example. Now, this 410 is now being exchanged. So which is that for every $1 you get $410. Now that is the quote price. Are you getting me now? Now, a bid price is the price a forex trader is willing to sell a currency pair. Now, so I have some dollars, right? And I need naira. Now, but the quote price is, let's say, 410, right? But personally, I am willing to sell at 450 instead of 410. Now, 410 is the quote price. I as a trader am bidding that I am only going to sell this $1 for 450. That is my bid price, right? That I am bidding, I'm willing to sell. Now, the ask price is the price the trader is willing to buy. So let's say I have some naira and I want to buy some dollars, right? And the quote currency, the quote price is 420, right? But because I want to take more advantage, like I want to be at a good side, I said, okay, no, I'm not going to buy at 420. I believe that this thing is going to go down and I'm going to buy at 410, right? So it's either the price at which I am willing to buy, which is 410, that is my ask price. The price I am willing to sell as a trader, that is my bid price, right? Now, the quote price is the price that is being quoted on the exchange. I don't know if you catch that, but I believe you understand. So if you have any question, you can note it down. Towards the end of this webinar, we'll be given room to ask questions and I'll be able to answer them. Now, let's look at this, the EURUSD. So this is just a breakdown of the base currency, the quote currency, and the price of forex pairs. So as you can see here, that this is what this is our base currency. I'm trying to get my okay, this is our base currency, and this is our quote currency. This is our quote currency, right? Now, this is the price of the forex pair, right? The quote price, the quote price. This is the price of the forex pair, right? So now for every this is what this means. If you are buying for every 1 euro, for every 1 euro, for every 1 euro that you want to buy, you would need 1.14 US dollars for every 1 euro. That's what this simply means, right? That's what it simply means. For every $1, for every 1 euro, you would need $1.14. Now, let's come to this term, which is called spread. Spread. I'm sure many of you might have heard about spread and not really understand so much about what spread really is, and how to identify it, how to calculate it. Okay? Now, a spread is the difference between these prices, the difference between the ask price and the bid price. Don't forget I said the bid price is the price at which I, the forex trader, you, the forex trader, you are willing to sell. And the ask price is the price at which you, the forex trader, you are willing to buy. Right? So we are on the same page now. Now, what is spread? Spread is now the difference between the bid price and the ask price. So when you subtract the bid price from the ask price, you will be able to get the spread. Right? So when you subtract the price at which you are willing to sell, which is your bid price, and the price at which you are willing to buy, when you subtract it, what is remaining is the spread. So look at this scenario here. Look at this scenario here. Right? Now, the bid price is 1.3587. The ask price is 1.3594. Right? Now, the difference between the bid price and the ask price is called spread. I hope you're getting it. Awesome. Fantastic. Okay, now let's proceed. Now, who are the major players in the forex market? Who are the players? Who are the big boys? Who are the big boys? Who are the you want to know who are the market participants? Who are the players in this market? So we have the commercial bank, the player, the foreign exchange brokers, they are players. The individual and small businesses are players in the forex market. The central bank are also players in the forex market. Right? Okay. Now, so we're looking at point in price. Many of you might have come across pips. About pips, peep this. Somebody tell you, today I took a trade, I made 10 pips, I made 20 pips. But yeah, you're asking yourself, what is pips? I'm confused. What's pips? So now, pips is the short word for percentage in point, or price interest point. It represents a tiny measure of the change in the currency pair in the forex market. A tiny measure. It represents a tiny measure in the change in the currency pair in the forex market. Now, the unit of measurement, which is expressed in pips. The unit of measurement to express the change in the value between two currencies is called pips. So now, how do you measure that this value in this currency has gone lower than this other currency? That factor we use, what we use in measuring the price, the change in value of currency pairs is pips. Right? Now, look at this. We have bid price is 2.0893. Then ask price is 2.0895. Now you see that the ask price is higher than the bid price. Now, which means this, when you subtract the ask price from the bid price, you get 2 pips. Right? You get 2 pips, which means when you subtract this from this, you get 0.00, right? 0.02. Now, this we consider so much of the last number of a quoted price. That's what we consider so much. Now, that 2 is the pips, is the unit of measurement that expresses the change in value of two currencies. Are you following? I can see Ibrahim, Adebayo, Tijani, Titus, Bello, Smart, Honora, Kelvin. I believe you guys are following. Okay, awesome. Now, who makes money from Forex? Who makes money from Forex? Who makes money from Forex? We have the active traders, the bankers, the banks, the Forex brokers, the central bank, the individual and small business owners, the investors, the hedge funds, the strategy managers. They are those who make money from Forex. Now, how do we take advantage of the Forex market over the financial exchange? Over the foreign, how do you take advantage? Number 1, the Forex trading hours. Number 2, the high liquidity ratio. Number 3, Forex volatility. Number 4, leveraging. Leveraging helps you to make money. Then access to wide range of tools to trade with. Access to wide range of tools to trade with. Forex provides you with liquidity, volatility, free time within the 5 days, because it's open. The market is open 24 hours, in 5 days. So from Monday to Friday, the market is running, accessible at any time. Right? Then working hours of the foreign exchange. Now, what are the working hours of the foreign exchange? Now, the Forex market opens 24 hours a day during weekends, but closes during weekdays, but closes during weekend. Now, so the market is opened from Monday to Friday, but is closed on Saturday and Sunday. Now, the Forex market opens on Sunday at 5 p.m. in the New York time, but in Nigeria, equivalent to 10 p.m. in Nigeria local time. Now, and closes on Friday at 5 p.m., which is equivalent to 10 p.m. Nigerian time. Now, why the Forex market opens around the clock? The foreign exchange market opens around the clock due to the ability of the Forex market to trade over 24 hours in different parts of international time zones. Now, different part of international time zones, and the fact that these trades are conducted over a network of computers rather than one physical location that closes at a particular time. Now, the Forex market is open round the clock from Monday to Friday, open to be traded as one market is closing in one international time zone, so also another market is opening in another time zone. So that is why the Forex market is always opened 24 hours in the 5 business working days. Now, a trading session is a period of time that matches the primary daytime trading hour for a given location. Now, London is the largest and most important trading session. London time opens around London session opens around 8 a.m. in the morning. Nigerian time 8 a.m. in the morning. That's when the London session opens. with roughly 34% of the market share of the daily traded volume. That's to tell you that the London is very pivotal, in the forex market. Very important in the forex market. Now, the America trading session. The start of this session occurs when European traders finish their working day, and this doubles the effect on the market. There are both European traders who are finishing their working days and the American traders who have just come to their personal computer to renew their vigor and new ideas. That's why the American session is known as the most active and aggressive trading session, both on the currency and on the stock market. Now, the American hour opens as at 3 p.m. every working day. 3 p.m. on Monday, the American trading session opens. 3 p.m. on Tuesday, the American trading session opens, and large influx of trades have been taken, during that period. So the period between 3, 4, 5, 6, the American session is actively open, and the American session opens until close to 10, 11 Nigerian time in the night. I want to believe you are learning a lot from this. Okay, now you need to do something to get started with trading. You have to open a demo account, and a demo account is that type of account that is offered by a trading platform like OctaFX, giving you that opportunity that allows a prospective customer or a trader to experiment the trading platform before putting in real money, right? So we encourage you to experiment. Download the OctaFX the trading platform, the trading app from OctaFX, and then open a demo account, get started, so that you can put in real money when you familiarize yourself with the market, right? Okay, now let's get something. Let's open the chart and see. Okay, now this is the OctaFX MT5 platform. I'm sure many of us are actually enjoying this session, so you want to read through the instruction. If you're enjoying this webinar so far, take a picture, post it on Instagram, share a story about it, and reshare. Awesome. So now this is the platform, the MT5, right? As you can see towards this the left hand side, you would see what this arrow is market wash. It's showing you the different currency pairs. So you can see now it's the currency pairs. Now we talked about the bid price, we talked about the ask price. So you can see that there is a price difference between the bid price and the ask price. I said earlier, the bid price is that price that the trader is willing to sell, and the ask price is that price that the trader is willing to buy, right? So you can see it here, bid price. So now all this price quoted here are what traders are willing to sell, and what is quoted here are the ask price are what traders are willing to buy. Now the difference between the ask price and the bid price is what we call spread. So we can see this is the interface. This is the quote session where you want to either buy at this level, or you want to sell at this level, or you want to buy at this level. Then this is the chart. So now there is a good news I want to share with you. I want to believe that many of you have been following OctaFX, have been following our webinars, and now we want to give you this amazing news. Now there is a giveaway package and program that we are rolling out. So let me take you through. Yes. So you can see it now. This is the package we have for you. this is a package we have for you. It's a raffle draw session, a giveaway session. You don't want to miss it. Show your mastery. Open at least one order, which means you must have opened an account. Get started. Place orders. It's a full giveaway. It's running for 4 weeks. We have 380 prizes to give. This September, you have a chance to get one of the 380 prizes. So open at least one order every week and join the raffle draw of 300 data vouchers, 60 Samsung phones, and 20 MacBook Air laptops. You don't want to miss this, guys. Look for yourself on the list of winners on Friday. It's a raffle draw. Get started and don't miss out from this. I want to believe that many of us, we've learned a lot from tonight. So I want to give you a few times so you ask your question and I would answer you. So if you have a question, kindly drop your question in the comment section. Yeah, I'm waiting for you guys. If you have a question, kindly ask your question in the chat box. Okay, someone is asking, Saint Gabriel is asking, what is the difference between a spread and a pips? Okay, now a pips just show the percentage change in point, right? So which means if you look from this place, right, to this place, now a pips. Now if you want to measure a pips, we want to look at the price difference of this region. I hope you are getting me now. This region, let me get in. Let me insert an object here. Okay, right? So we want to know this region here. So we want to know the difference between the price of this region here, or let me make it now the difference between the price of this region here is pips. So here we have 1.37916, right? And at that point we have 1.37614. now the price difference here will have 0.00332, right? Now that's to tell you that this has a pip difference of 300 pips, right? Now that is for percentage change in point. Now for spread is the difference between the ask price and the bid price. Now spread is what you are being charged for taking a trade. So now spread is what you are being charged for taking a trade, and it is just once the difference between the ask price and the bid price. But a pips is the difference between price movements, price change. So when a price change, either upward or downward, we want to look at it by how many pips did this price change. Oh, it moved up by 200 pips. No, it moved down by 100 pips. So now what pips does is to tell us the percentage change in point, of the price movement. But what spread does is just to tell us what is left after subtracting the ask price from the bid price. Now what is left is the profit of the brokers. That's the difference between the ask price and the bid price, which is the spread is what the brokers charge and take as profit. Now, but for percentage in price, when you open a trade, if you buy a currency now and it rises up, now it moves up, let's say by 100 pips. You can see now that tells you the distance at which it moved, right? So that's the difference. Okay, someone is asking, okay, so how can you read and understand what the chat is saying? That is why you need to follow OctaFX for quality information and education. So educational content, keep following our webinars. We have another webinar coming up. Next, just follow our website. You see series of webinars coming up. I'll still be here to put you through. These are the things we'll be doing. So for today, we started with taking you through the fundamentals. The what you need to get started in Forex. So when you stick with us, you get to learn more, right? Okay, I guess I've answered that question. Okay. Okay, some of you are saying, how do you get started? How do you, for the raffle draw, a link will be posted. So click on that link. Just click on that link. Okay, someone said, please talk more about fundamental and technical analysis. Yes, we'll be doing that in our subsequent webinars, and that's why you need to stick with us and you need to follow us. So just keep following our page. We're coming up with series of webinars giving quality content, and you get to learn that. Okay. Someone said, yeah, if you want to, you are just coming, if you're just coming and you are late to the webinar, you can always watch it again. So next time, don't come, so that you can have first hand knowledge. Someone said, I want to know how to predict the trend from candlestick. Oh yeah, of course. So that is what we are doing, and that's why we are here. So today we just started with what is important, how to get started with Forex. So over time, we'll talk about the technicals, talk about the fundamentals, and we have resource on our site. So you just check the OctaFX site and you see it there. Okay. What other question? Okay. How risk can Forex trader? Okay, so you're asking how risk can Forex trade be? You want to say how risky, if I understand that question very well. Oh, so of course, you need to understand something, that the financial market is how do I put it now? It needs knowledge, right? So you can't just wake up one day and want to start making money from the market. No. So it has to do with you having quality knowledge before getting started, and that's why we are putting out this knowledge out there. Then you sign up, open a demo account, practice for a while, then you make your first deposit, and before you know, you follow our quality educative content and you ask questions. You get to understand better what to do, how to prevent yourself from losing money. So, but today's webinar, we are focused on what you need to know about Forex. Okay, fantastic. So I want to believe you're asking what's the difference between a real account and a demo account. So a real account, let me start with a demo account. So a demo account goes by the name demonstration account, is a demonstration of the real account. So is like what happens in the real account, what happens in the real market also happens in the demo market, right? So the demo market is just a market where you can use a free virtual money to trade real time market. You can take trades real time, but the money is not real money. You get, it's just a virtual cash, just for you to be able to get your way through, learn one or two things. So it's good you get started with demo account, and then you push further to open a real account and make deposit. Okay, Um. Okay. Okay. So yeah, you're glad you joined. Awesome. Awesome. We are glad to have you. Don't forget our raffle draw, which is let me let you, some of you who are just joining us, you don't want to miss this. Show your mastery. Show your mastery. It's running from it's ending by 1st of October. You don't want to miss out from it. We open an account, open orders. We are giving out 380 prizes. 380 prizes. It's going to run for 4 weeks. We